All right, good afternoon, everyone. Welcome to Identifying Impact Definitions and How to Avoid Common Pitfalls. I'll be your host today. My name is Tim French, and with me we have Maria Lucas. Maria is the Applied Advisory Economist here at IMPLAN, and we're going to be walking through a handful of the common things that we see that can go wrong or we get a lot of questions about. So this is both a webinar designed specifically for you if you've been in impact analysis your entire life and you want to discover those very specific things you can do to ensure that you don't make simple mistakes. But also, if you're very, very, very new to impact analysis, this will be useful for you as well. These are most of the questions. This will cover a lot of the questions that we've received over the course of past webinars, things we get emailed about all the time. So even though we're going to be using the IMPLAN software to explore these very broad concepts, these do apply whether or not you are using IMPLAN or whether you are the researcher or the economist involved directly in assembling the analysis. All of this stuff applies all the way across the board. So even if you're just fact checking an analysis that you've read recently, this is stuff, these are particular clear ideas you can use to get to the bottom of whether or not an analysis is done very, very well. So without further ado, I will add that we are recording this webinar and everyone who is registered will receive a video recording of this webinar after we've concluded for the day. So if you've missed something, or if you're like me and you'd rather just listen and take notes later, then you will receive a copy of this webinar very shortly after we get through all the material today. So without any further delay, Maria, thank you so much for sitting down and going through all this stuff with us.
Absolutely. Hey, Tim, I'm glad to be here. I'm looking forward to kind of covering a wide scope of really key considerations and doing an analysis. So I think this will be helpful for everybody attending. Thank you guys for joining us.
Cool. So what are we looking at specifically today?
Absolutely. First, we'll just set the stage with those key questions that you need to take into account when you're defining your impact. And then we'll go through each one of those things. So we'll talk about defining who, defining what, defining when, and of course, defining where. Once we've covered all of these key considerations, we're going to open up the floor for questions and answers because I know we're really only getting a chance to cover some of the most common things that people run into. So please feel free to unleash all your questions you may have on this topic and even include any requests of things that you hope to see going forward.
Cool. Yeah, the questions are awesome. We covered them because it helps us drive the quality of the webinars moving forward. So this is your chance to participate in how we do these things here.
Absolutely. Great. So let's go ahead and talk about defining an impact. So whenever you get into IMPLAN, of course, what you're looking at here is the impact screen of our newest version of IMPLAN. So in IMPLAN, the impact stage is really where you are defining, of course, your impact. And that's going to be defined with two elements, your event, as you can see on the white field on the left, and then your group, this box here on the right. So each one of these kind of boxes and values and blanks you see in this table are going to be how you go about constructing your impact and letting IMPLAN know what's happening in your real world impact so that IMPLAN is appropriately interpreting that within the software. So you'll see this screen a couple more times as we kind of navigate through each one of those things. So who? That's really the actors that are involved in your study. So that could be a sector, a commodity, or an institution or household, or even somewhere in between. It could be even labor income that's paid from a sector to a household. So really, whoever is receiving some new spending dollars or creating new spending in the economy, that is going to be the people you want to think about when we talk about who. Who in the software is defined as a conjunction of type and specification. So of course, if you're looking at a sector, that's going to be defined in specification. The type for that is of course going to be one of our industry event types. But you may be specifying a specific commodity, in which case your type is going to be a commodity output event. You'll see two examples of those, but between type and specification, you're able to communicate in the IMPLAN software who is being affected or who is creating the impact. Now what? That can be a lot of different things depending on what value you have available. Jobs, output or sales, or income could be a combination of all of these things. what is inserted into IMPLAN in this value field. Once you've clarified what the type and specification of the event is, you can put in the magnitude or level of the impact in this value field. When? That's your dollar year, and it should reflect the year of the event input dollars. Dollar year may not always be the year in which the event occurred, often is, but we'll talk more about that once we get diving deeper into when. When is specified here in that impact screen in dollar year. It's going to default to 2019, the current year, but you can definitely change that depending on your analysis inputs. Where, and that's really your study region. IMPLAN in this newest version has a lot of capabilities and flexibility around region. So it may be multiple regions, it may be just one region, or you may even be using MRIO, which we'll talk about more as we continue to dive deeper. But it's really a function of where your impact is taking place and where you'd like to measure the regional effect.
And MRIO, that's so you've got that highlighted there. That's multi-regional input output, but what does that actually describe?
Actually, absolutely. So MRIO, as you can see, yes, it is multi-regional input output. And what that does, it actually allows you to link regions. So a lot of times we see people struggle with the scope of their region. They may know very specifically where their direct impact is taking place, even all the way down to the zip code. But of course, a zip code is not really very interesting or telling story about the regional effect. So often people want to see maybe the entire county or the entire state's experience of the effect. And so MRIO allows us to do that. You're able to maintain the small region in which the direct effect is taking place and then link regions where you want to see spillover effects onto. This is really great because it's actually improving your study because it's even improving the regional identity of the regions that you're picking and including in your study rather than just creating this aggregation of one big lump sum region. So you can choose to use MRIO or you can just simply pick one single region. Totally up to you, but as I said earlier, it's really a function of wherever the impact is taking place and where you want to see it. And so you really have a lot of options there.
Cool.
So before we jump in, it is always important to keep this in the back of your mind. If you'll have more questions on this is definitely a good place for us to continue to expand in future webinars. But while you have all these ideas around how to shape an event, it's important to kind of step back and say, how am I actually framing my entire analysis? And how am I telling IMPLAN the story of my impact? To do that, it's really important that you be sure to model all the expected effects on final demand as their own event or somehow in your impact screen. IMPLAN only captures backward linkages. So if you have some activity happening in your economy that may cannibalize other businesses, in training, I know we often talk about how a new hotel in your region may cannibalize other hotel and accommodations because there's only but so much demand in a given region. So that's what we call a net effect, where one impact may affect other businesses in a negative way in a simultaneous manner. Now, opportunity cost, that's when you're considering an either or situation. I'm doing this. Is this the best use of my money? Is there some way I could use these funds in a way that's more impactful to my region? So that's a situation where you have options. Often we see this with tax incentives. So a company may be receiving some tax benefits and where they don't have to pay property taxes. So it's important to make sure that that use of property tax wouldn't be used in some better way other than providing that business the tax incentive. Of course, for businesses, it's important for them to prove to regions that that incentive is definitely worthwhile because it's the very best use of that region's funds.
That's an interesting one to me because that's a pitfall that happens in the mind of the readers of your analysis. They can't know what else could be done with whatever available resources we're trying to model for. I came across an interesting study recently that had been updated in 2016 about how researchers at Cornell had developed a framework for analyzing the economic impact of food hubs, which also accounted for those opportunity costs and those net impact elements. Because of course, people aren't going to buy more food simply because there's another place to buy food. They're going to stop buying their food from other sources. So those kinds of things, teeing up your readers to understand that you're just talking about one specific thing, but there are other things that are not being analyzed that should be considered.
Yeah, totally. That's a great example of a net effect, and we see that often. If they went to the extent of saying, well, this food hub is receiving some subsidization, what could that subsidized funds be used? So definitely, and totally a lot of ways you can incorporate these other considerations, and are definitely important to make sure that your audience knows that you've fairly evaluated the impact and have looked at all angles of how it's truly going to affect that community. All right, so let's dive a little bit deeper into each one of these things. And so we're first going to talk about that who, which came as a function of both type and specification. So to hit that, we're first going to talk about capital purchases, which both incorporates type and specification. So you can see I have this picture of really high-tech stuff that looks like it could be in an astronaut's cabin with computers, wires, monitors, all sorts of things here. So this is going to be what I'm going to use kind of to frame an example around this. Whenever you are modeling a capital purchase, it's important to ask yourself, do I know what industry is actually producing this good or service that's being purchased? And do I actually know when it was purchased? If not, and I actually just know a bunch of stuff was bought, then a commodity output event or even just a retail impact may be more appropriate than impacting the producer. Now, when does that actual impact to a producer come in? You would only do this kind of rare situation of a capital purchase through the actual producing industry if you know exactly what industry produced that commodity. As you know, in IMPLAN, some of you may be familiar that commodities can be purchased by many sectors. You also must know that that item was purchased directly from the producer or know how much dollars are actually going to that producer, also known as the producer price. In general, whenever you're trying to really capture production, it is important to know the time of production. So that kind of gives you an idea of when you could go straight to the producing industry sector to model your impact, but it's probably more common for capital purchases to be made through wholesale and retail and for only the purchaser price to be known. So the actual value that you pay the retailer or you paid the wholesaler for that good. So that includes all those margins, which we won't get into too deep today, but Tim has a really great blog on. But those margins are really what the wholesaler, retail, and all that are going to capture. So a purchaser price is going to include all those things as well as the cost of the actual goods sold.
So you could think of that, I guess, as, if I buy stuff directly from the place where it was made and I go and pick it up, I'm not paying anyone to transport it, I'm not working with a middleman, then that's just the cost of the good. But if I went to Walmart to pick it up, now I'm paying for all sorts of other stuff
Absolutely. And the cost on your receipt from Walmart would be considered the producer price there. That price you would have paid going straight to the manufacturer, we call producer price. So that's a great way to think about it. So here's those two more common situations that you may be in where you have a purchaser price. On one hand, you may only know the retail or wholesale place of purchase. Maybe I bought a bunch of electronics, but I don't know what particular item was purchased. The best thing to do here is impact the retail or wholesale sector from which it was purchased and use that purchaser price and apply margins, which you'll see an example of here in a second. The second situation, when you are able to drill down further to what item was purchased, you can actually impact the commodity that was purchased, still using your purchaser price and applying margins. But with this, you're actually going to capture a whole lot more aspects of that impact all the way through its actual production. Unlike with retail or wholesale, you're only going to capture the retail or wholesale impact. So this chart here is going to help kind of shape the example that I'm going to walk you all through. I've picked North Carolina as my region. It's where the impact is taking place and where I want to see the impact using a really simple region here. Who's going to be impacted? Without considering IMPLAN sectors, we know manufacturer is going to produce it. Transporters are going to move it from the manufacturer to the wholesaler. The wholesaler is going to do its own operations. And then the transportation from the wholesaler to the retail will create more impact. And then finally the retailer. As you can see, all the things we buy from retailers and wholesalers go through a journey from production to actually getting into your hands. So all these margins that get applied through this process are really the value of providing you that commodity in a convenient location. So when we apply that in the context of IMPLAN, we can either affect all of those things by modeling a commodity output event for electronic computers and actually capture the full chain that we just talked about. Or if we don't know as much, and as you saw in that picture, we had a lot of electronics there, we may only be able to model a retail purchase.
So the pitfall here is very often it's easy to merely impact the industry to be related to the activity you're thinking about, but if you're not paying attention to, or if you if you know more information, then you can get a little bit more accurate by deciding to do a commodity impact rather than industry impact.
You've got that exactly right, Tim. Absolutely. So here's how I would set that up. You can see in my first event on the top of the page, I have retail level impact with an industry output event for sector 398 retail electronic appliance stores. So this is me going and buying a bunch of electronics from maybe Best Buy. Second, I actually have a commodity level impact with a commodity output event for electronic computers, the actual commodity. You notice in both cases, I have in the margins in the advanced menu selected as total revenue. Here and here, those blue dots for all of you, if you're having trouble finding, I know there's a lot going on this page. What that's telling IMPLAN by selecting total revenue is that the value I'm going to plug in here is going to be a purchaser price. So IMPLAN, I need you to apply margins for me. And we'll see the benefit in real time once we get into the value section of this webinar, how this is actually going to affect the results that you're going to get from this. Just to give you kind of a sneak peek, this retail impact on top is only going to get the effect of the retailer itself. So it's going to take whatever value we plug in, apply the retail margin, and only see the impact of that portion. Whereas the commodity output event is going to take that entire value and split it across each chain from production to point of sale and show the effect on each sector involved in that. So more to come on this, but this is how it would be really important to make sure that we are picking the right sector, right specification here. Now, this being said, you don't see an option here for industry output with the producing sector. And that's because if I plugged in a purchaser price to the producer sector, I'd actually get an overestimation of the impact to that producer because that price actually includes not only the cost of the good, but all those different chains of transportation, wholesale, and retail.
So how significant can that overestimation be in your results?
It depends on the retail margin for that sector, but say that retail margin is something really high, like 50%, then you may be overestimating your impact by double.
So if we're talking about, furniture where there's a very high markup,
absolutely,
then your results could be severely skewed.
Absolutely. Very important to know that and make sure that you're picking that appropriately. And the key is, of course, they are knowing what your value is so that IMPLAN is interpreting the thing as your understanding in your own mind. All right, to move to a little bit more simple idea of selecting the appropriate type and specification, we're going to talk about some sector selections that can get people a little bit hung up. So headquarters versus offices. Bunch of businesses have both, of course. Think of, your regular workplace, things are happening, and then there's, of course, a headquarters, usually somewhere else. So we have some examples of businesses that do have headquarters. So I have limited service restaurants here. Think of that as any sort of restaurant, perhaps a Panda Express. I don't know why that came to mind, but a limited service restaurant would be kind of something like that. But of course, Panda Express has a headquarters somewhere. So if you know that a headquarters for Panda Express is open, you definitely don't want to model it through this sector. As you can see, I have a couple other examples of that. Pharmaceutical. I quickly think of someone like Gilead. They have their manufacturing warehouses, but they also have headquarters. Electric power transmission and distribution. Think about Duke Energy. They have administrative people working in the headquarters, but then of course have employees actually going out there and repairing electric power connections when things go wrong. Two very different activities, two very different spending patterns. And as we continue, you see warehousing. That's going to be things like Amazon. They have their own headquarters. And then finally, I have retail for things like garden equipment. Think about something like Lowe's and so on.
So it sounds like a really good question to ask when you're setting up an analysis is whether or not this business has multiple locations. Because from after that, you can inquire after, are all of these locations doing the same business activity? So like with Panda Express, as you mentioned, the way that a restaurant location spends its money is going to be drastically different to the way that the headquarters does.
Absolutely.
So is the headquarters the same industry despite whatever business activity they're doing?
Yeah, that's a great question. There's two sectors that kind of fit around headquarters. There's one more for like corporate corporate type of headquarters, like true headquarters, and then we also have like an administrative office type of sector. So one of those is likely going to be your best bet for headquarters. So selection there is much easier, as those operations within that kind of facility are going to be pretty similar. Awesome. All right, so one more like that, construction versus operations. We often see newcomers to IMPLAN kind of get tricked up by this. Here on the right-hand side, we have sectors that are operating sectors, and on the left-hand side, we have the corresponding construction sector. So I'll let you all kind of take a quick look at that, but of course, the spending at an actual hospital once in operations would be vastly different than constructing the hospital itself, and so on. So we see this often when it comes to power, just because that can be kind of tricky, since operating power can involve some sort of maintenance and repair of that infrastructure. But constructing that original new power is vastly different than maintaining the operations of that energy. Great. So let's move on to defining what? The value, that little next point of defining our event or impact. Let's talk about what output is, and then we'll go through a couple different sectors where output can be tricky. So output is the value of production for a given year, and it disregards how much of the actual production was sold in that year. And so output for each sector is always going to be in producer prices for that given sector. Now, if you plug in purchaser prices like we just talked about, you can allow IMPLAN to provide margins, and what it's doing is basically figuring out what the producer price is for all the margins there. So one place output can get tricky is construction. So construction does exclude some things that some people make the mistake of including. Output for construction sectors is simply the total cost of that structure. It excludes furnishings, fixtures, and equipment. So the things that you fill that building with, all the fancy lights and tables and chairs and so on, those things are going to be modeled separately and are considered what I was talking about earlier, capital purchases.
Okay.
All right. So manufacturing versus service, we've talked a little bit about this, and we'll revisit it here. And so output is going to include net of inventory changes. Manufacturing likely involves inventory, where service sectors, non-retail and wholesale service sectors, output is typically just sales. There's usually not a lot of inventory happening there, of course. But for manufacturing, output equals sales plus net of inventory changes, which expands to simply subtracting the sales from inventory, since we're only wanting to count production from that year, plus the old unsold new inventory, since that, of course, is part of the production value of that year.
So this is worthwhile to mention even in your appendices, to say, when you're looking at this number, these are the things in your final results when you're putting your report together. These are the things included, and these are unique to this manufacturing sector, especially if you're doing an impact where you're looking at not only the manufacture of some things, but also the retail or wholesale sales of those things, and you want to put those alongside each other. It's a great idea to be very explicit with what's included, what's not included, so when you're looking at these numbers, people understand what they represent.
Absolutely. The more information you can provide your readers, the better. That's a great suggestion, Tim. All right, so how about output with retail and wholesale? I just mentioned kind of service sectors other than retail and wholesale. So that gives you an indication that retail and wholesale sectors do only produce a service, and that's simply the convenience of bringing you that commodity. But they do, of course, have to operate their store, keep their lights on. So retail or wholesale output is simply the gross margin of what that retailer is keeping, not the gross sales of the total cost of the goods of what they're selling. So for a retail sector, output is equal to the retail margin, and for a wholesale sector, output is simply equal to the wholesale margin. So let's continue on with this analysis that we were just framing. So we decided that we could either model our capital purchase of all those fun electronics in that picture either through a commodity by specifying we're definitely purchasing computers, or if we have that more kind of lump sum purchase of a bunch of electronics, we could do it through a retailer. And as I mentioned earlier, the commodity level impact is going to show us a lot more of that impact, showing us each stage of that chain, where retail is only going to capture the retail impact. We're going to go ahead and use the purchaser price of $8 million here, and we'll assume it's taking place this year. So we'll go ahead and take a look at what this looks like in the software. Before I show you the results, I apologize. Let me show you the setup of the event. So I have a industry output event that you already saw, as well as that commodity output event, and I have plugged in the $8 million for each of them and drugged them over to my group, where you see I have the year specified as 2019 and the region specified as North Carolina. Here I have my two events, my retail level and my commodity level impact. So let's take a look at those results. Okay, great. So what we have here, we'll be using those in just a second. Here's my retail purchase impact. As you can see, I filtered to the commodity level impact, and I have dollar year set at 2019. So what I'll see in my results here, I'm looking at the output detailed results. And so my total output is going to match up right around that $8 million. But where does that $8 million go? We see a large chunk of it is going to the electronic computer manufacturing and that sector 301. So they get the biggest share of that whole purchaser price, the person who likely produced the most of that commodity. We see the retailer actually gets the second biggest chunk, but we actually see there's another producer. So 303 is another manufacturer of computers, but because electronic computer manufacturing has a bigger market share, we're seeing bigger dollars go there. So of course we then have our retail impact, or getting a big chunk. You get a wholesale impact of another chunk, and you can see how this continues to go. Other federal government enterprise pops up here, and that's likely because they also do some activity in producing of either transportation or computers possibly. And then we see all of our transporters, truck, air, and rail, that are involved with transporting the commodity itself between production and wholesale, and between wholesale and retail. So we're getting that whole $8 million impact, but we're getting to see all the sectors that it affects. Each one of these sectors has its own chain of backward linkages, and all of that is being included in this impact that impacts this region of North Carolina. So here in this other tab, I have our retail level impact. And as you can see, I only get an impact of about $2.5 million. So that rest of my $8 million is gone. It's a leakage. IMPLAN has no way of knowing who produced or who transported that commodity because I haven't told IMPLAN what the commodity is. I'm simply saying I'm buying some stuff from a retailer from electronics. So it's using a much more broad margin, because of course margins may be different for a computer versus a stapler that I may happen to buy at Best Buy. So you can see they're having to use an aggregated margin, and all it can define is what the retailer may expect to keep. So we'll only get the backward linkages of this retailer spending from operating its store and paying its employees. So you can see if it's possible to pinpoint the commodity and you have confidence that that commodity was produced in the given year, you're going to get a lot bigger impact by including the commodity and margining there.
So that's all coming from this setup then?
Absolutely. So this is how we set that up, and it's really enjoying the brand new version of IMPLAN, because we can simply apply those two events to our one region, and we're off to the races, and we're able to kind of toggle through those results. All right, so one last value to talk about that often gets people hung up is employee compensation. It's important to always know that IMPLAN's employee compensation is a fully loaded payroll value, which includes benefits, and it's the total cost of the employee to the employer. If you have a wage and salary number, IMPLAN does have a converter, but if you were to plug in that wage and salary number directly into IMPLAN, you'd end up essentially underestimating your impact. IMPLAN is going to estimate how much of your employee compensation is payroll tax. It's going to take that and treat it as a leakage. So if you have included a number that includes payroll taxes, you're going to end up with IMPLAN sucking off dollars that you did not expect it to. And if you really would like to report your results also as a wage and salary number, you can of course convert your results back into wage and salary numbers to report. But it's always important that IMPLAN and you are on the same page about what your values truly mean.
So really, it sounds like a lot of these pitfalls really come down to understanding how to translate what you want to model into what whatever modeling tool you're using understands to be that thing, so that when you're reporting it out, you don't run into those scenarios where you've published a report and the results are called into question because of a minor detail, and then validity of the whole report is called into question over that one minor thing.
That's absolutely sure, for sure. We have definitely seen that. All right, so let's move into the next stage here, defining the when, which is ultimately indicating your dollar year, as you have seen on that impact screen. And so this gets back to the importance of specifying your dollar year appropriately. So what dollar year does is really allows IMPLAN to assign a deflator to your value. So a deflator simply adjusts any past or future dollars that you're plugging into IMPLAN to the model dollars, so the same year as your data set that you're using. Therefore, dollar year should always be defined as the year of the data input. This year may not always be the same as the year of your event, as we talked about earlier. The use case for that is typically whenever you're using older study data. Say you may have a survey you're relying on that happened in 2015, and you expect the survey data about that event to be applicable when that event is reoccurring in, say, 2018. So even though your event is taking place in, say, 2018, 2019, 2020, whatever it may be, if you're using survey data from a survey that was conducted in 2015, you need to let IMPLAN know that those input dollars are in 2015 dollars. So a dollar year setting in your results really inflates or deflates your results to the displayed year. So if you plug in a number in your event with a certain dollar year and then maintain that same dollar year in your results, then the value you plugged in the event stage should be maintained through to your results. And that's given that you haven't changed your local purchase percentage to anything other than 100% and that margins have not been applied. So we'll see that example right here in just a moment with a multi-year impact. We're going to look at a 2-year construction with happening in 2019 and 2020. The total construction cost would be $10 million, but $5 million is going to be spent each year. So right now we're going to jump into the example of what it means to appropriately model each of those $5 million in the appropriate year rather than plugging in that $10 million as one lump sum, as of course our deflators are going to affect that. So again, here's our chart to kind of set up our analysis. We're going to do this impact in Lemire County, Colorado, using the sector for construction of new educational structures. It's going to be taking place in 2019 and 2020, each year seeing a $5 million spend on construction. So let's take a look at the effects of those deflators. This is the way I've set it up. One event showing my yearly construction of $5 million in that sector for construction of new education. But on the right, you see I have created a year 1 construction and a year 2. Dollar year in construction year 1 is set to 2019. Dollar year in the second event, group is set to 2020. So I'm simply dragging that event to each one of these groups so that I can show that that $5 million is going to take place one time for 2019 and then again in 2020. Specified, of course, using my dollar year. So let's go ahead and take a look at those results. Here I'm looking at, go ahead and open up my filters. I'm looking at construction year 1 group with 2019 set as my dollar year. And so because I plugged in $5 million and said in my group dollar year is 2019, when I set the filter for dollar year in my results to 2019, I see that same exact $5 million. So as you would expect, in my second group, construction year 2, when I have dollar year set to 2020, I see $5 million as well. Well, what do you think happens when I change this to 2019? Well, let's take a look. By running my second year, which actually is taking place in 2020, when I look at those dollars in 2019 dollars, I'm going to see something different than 5 million. I see 4.9 million instead, just slightly under, because a 2020 dollar deflated down to a 2019 dollar is going to be worth a little bit less.
And you can flip that back and forth, like going up and down.
Mm-hmm. Absolutely. So I'll do the same for my 2019, my construction year 1. If I do the same thing here by inflating a 2019 dollar up to 2020, that same $5 million created in 2019 is going to be worth a little bit more in 2020. And so that's why it's important to decide early on how you want to report these results as well. Of course, here now you see I have just over $5 million when I'm looking at construction year 1 in 2020 dollars. So if I get rid of the filter for the group itself, and run my results as a lump sum for 2020, I'm not going to see $10 million. Instead, I'm going to be seeing slightly over 10 million. The same goes for if I look at this in 2019 dollars as a lump sum. Since I have a 2019 and a 2020 value, by looking at this in 2019 dollars, I'm going to see a value just under 10 million, as you see here with 9.9 million.
So I see a lot of people who are running analyses not terribly often, but once in a while you read a study where a researcher or an economist is trying to project out a certain number of years and say, of course you have a 5-year construction plan for a very large office park or something of that nature. How far out into the future can you actually model? I mean, obviously we're staring into crystal balls no matter what we're doing, but to what degree should I distrust a forecast?
That's a great question. Well, with IMPLAN, we really just have a rule of thumb recommendation there to not go out beyond 5 years into the future, just because as every year you get further out from now and diving into the future, the less likely that those numbers are going to be relevant to the current economy. Our economy is always constantly changing. So if I run an impact of something happening in 2025 on a 2018 model, well, the picture of the economy I'm representing is still 2018 economy. So if I expect that 2025 economy is going to be vastly different from my current economy, then that may create some issues, which is just important to note in your study. If there's ways that you can internalize the changes you expect, definitely do that. But 5 years is our recommendation, but it's really important to note whenever there's big changes in your economy. So for example, if you're looking at Katrina, Louisiana, from year between their devastating hurricane, their economy changed drastically, and that's from one year to the next. So if there is some sort of recession or natural disaster happening in the economy, that the data set that you're looking at for a previous year may be less reliable for that reason. But likely an economy is going to stay pretty consistent and within 2 to 3 years. So it's really when we go out to 5 years and on that you want to consider whether or not this is a really accurate picture of the impact taking place. All right, so finally, let's talk about where, and that's really defining our region. So just one thing to pinpoint, we've already talked about MRIO a bit, multi-regional input-output analysis. So if you want to learn more about that, we did our previous webinar specifically on that topic that you can learn more about. So let us know if you have any issues finding that webinar recording. But just one thing I wanted to highlight about where for this particular webinar was just to remind everybody that the social accounting matrix, the real heart of IMPLAN's calculation, is specific for every single region. So that social accounting matrix defines really interesting things about the interactions in your region, including savings rates by household income groups, tax rates and things like that. One thing that people aren't always aware of is that social accounting matrix also includes in-commuting rates. So we talked about employee compensation earlier and modeling that in IMPLAN. I talked about the things that IMPLAN interprets an employee compensation number to include and will treat it accordingly. And so one of those things is IMPLAN does assume employee compensation includes all compensation for people that work in that region, including people who may commute out of the region. So what IMPLAN does, if it has a positive in-commuting rate, meaning people are coming in from outside of the region, it takes that rate and treats that as a leakage, since we do assume that likely people are going to take their money, take it home with them where they live, and spend it there, rather than in the region in which they work. So this comes up a lot when we deal with things like construction. People often already know how many of their construction workers are local and how much compensation is going to be generated for local construction workers. So they treat that number as what IMPLAN is already interpreting, plug it in, but IMPLAN may say, well, I already know this region on average has commuters, so in-commuters, and so let me go ahead and reduce that number before running it as spending in this economy. And so in that case, you'd end up with an underestimation of your actual impact. So there are ways to kind of adjust your number to basically compensate for that, and we have a great article on that, so let us know if you're interested in taking a look there. Lots of important things to always consider about your region. It really does define the identity of that region on all the ratios. So there's a lot more to talk about here, so let us know if you have questions, but this one aspect is what we wanted to highlight today.
Awesome. So that brings us to Q&A. We did get one interesting question. If we can jump back to the example where we were modeling in North Carolina. So with the purchasing of electronics in North Carolina, if you choose the commodity approach, most or all but the retail margin may have the impact occurring outside the study area. If all or most of those components are produced outside of the state, is that the case?
That's a great question. So IMPLAN, whenever it applies those margins, it's also applying the regional purchasing coefficient for each one of those things. So what it does is use the regional purchasing coefficient at the commodity level and applies it to those sectors. So if my electronic computer manufacturing wasn't happening locally, well, IMPLAN is going to incorporate that by applying the RPC for that. And now you do have to specify that in your impact that you want to let IMPLAN apply the regional purchasing coefficient as your LPP. Otherwise, you may be overestimating your impact. If I don't do that and just say, I'm going to let IMPLAN decide the margin and I'm going to assume that this was happening local, you definitely may be running into an overestimation. So be sure in the right situations that you're letting IMPLAN know you want to use the regional purchasing coefficient as your local purchase percentage so that it can say, on average, this commodity is the demand for this commodity is met in the region on average by X%. So if that thing is only purchased in, if the only like maybe 2% of the demand for that thing is met in the local region, then IMPLAN will apply that as well to the value and say, okay, well, 20% of the purchaser price is going to this margin, but of that 20%, only 2% is local. So that's going to further reduce the impact to your local region. So great consideration to make. I always recommend people do use the RPC as their LPP whenever they're applying margins at the commodity level.
Excellent. I've got another question here, and I think this is kind of relating back to headquarters versus operating locations, and also thinking about retailers, wholesalers versus manufacturers. When we're talking about an energy sector, what about the production of the energy equipment such as solar panels that are needed in order to set up that operating location? Are those going to be modeled as capital purchases, or are they included in construction?
That's a great question. So construction will those are really capital purchases and should be included kind of separately from that. Things like the maintenance of of those things are going to be included. The depreciation of them are going to be included, but not the actual purchase. So if you have if you know that the solar panels themselves are being manufactured locally, you definitely want to try to capture that impact as a capital purchase. Otherwise, often your solar panels are produced across the country, and what you really want to see is the impact of installing it in your region, in which case that construction of power is perfectly appropriate.
Cool. I've got two more questions. I'll try to shoehorn these in with the limited time that we have remaining. The first one is, how do I report? So if we're jumping back to that construction example that you had shown us, where we had the multi-year construction phase, in 1 year we're spending a certain number of dollars, and the following year we're spending dollars that have been budgeted in the previous year and that year's dollar amount. And when we come down to reporting the actual total impact as a result of those two construction years, can you just add those years together?
That's a great point. You could add them together, but it's really important that you communicate what number that means, what that number means, what dollar year is it in. So as we saw in these results here, I'm combining both events. Sorry, I keep saying events, I apologize. Both of these groups, year 1 and year 2. Here we're looking at in 2020 dollars, and we have this direct impact of just over 10 million and a total impact of 14.8 million. Excuse me. We could report this as is, but it's very important to say it's in 2020 dollars.
So the other question is kind of related to that, and that's one I think I can answer, because this is one of my favorite things to consider when you're setting up an analysis is, when you've got these two construction years side by side, how do you report the jobs? So you can see the employment column here where we have direct, indirect, induced, and then of course your total employment as a result of that construction. It's a good idea to look at a single construction year and use that as your total employment for the construction project. And that's because if you think about the people who will be working on building the structures that are in question, those are likely going to be the same individuals, the same employees from one year to the next. As is usually the case with a construction crew, if you're doing drywall and you have 2 years worth of drywall to install, you're going to use the same employees to do that project. So the kind of stepping back from that takeaway for me is to think about even though you can plug things in, you can get results out of the system, whatever system you're using. It's a good idea to sit back and think through the actual physical process of what it is you're modeling. How many people would it take to do this thing? Or how many employees would you need to employ to complete a project like this? So that's kind of the part two to that question. If you're to report these construction numbers together, the recommendation is, model everything together and report the dollar impacts as a combined number. It doesn't hurt either to break that down into how much impact you have in terms of dollars between one year and the following. But when it comes to employees, err on the side of reporting fewer employees, just those who would actually be working on the project. So I regret to say we're out of time, so we'll wrap it up and end it there. If you have any follow-up questions, do feel free to email us. Our email, you can contact us or you can contact Maria directly at support@implan.com or call us there at 800-507-3268. And of course, you can also get in touch with us at events@implan.com. As I mentioned at the beginning, we did record this webinar, so all of those who attended or registered will receive an email with a link to download and view the webinar, as well as links to as many of the things we referred to outside of the webinar, the study by Cornell, a handful of other things that we referred to. So you can review that stuff alongside your review of the recording itself. So with that being said, Maria, thank you so much for walking us through all this stuff.
Absolutely. Thank you, Tim. I'm so glad to be here. Look forward to any follow-up questions you all may have. Thanks for joining us.
All right. Thanks, everyone. Bye.